Welcome to The Explainer. So today we're cutting through all that daily market noise and those sensational headlines. We are going to look purely at the hard data driving the transformation of an absolute American icon, Ford Motor Company. Now, if you follow the auto industry, you know the narrative is totally dominated by the hype and, well, the hurdles of electric vehicles. But what if the real story and the real value is hiding just beneath the surface?
It really begs the question, right? Is Ford the market's most overlooked stock right now? I mean, think about this stark contrast. We're looking at a company with a massive, century-long legacy, a completely dominant market presence, and deep integration into the global economy. Yet, its current stock price is hovering right around the low $12 range. That puts its total market cap at roughly $50 billion. Now, that might sound like a huge number, but wait until you hear the underlying financial mechanics compared to that valuation.
Okay, let's dive into this. $187.3 billion. Yeah, billion with a B. That is Ford's full-year revenue for 2025. It instantly anchors the sheer massive scale of their current business. I mean, they aren't just surviving out there. This actually marks their fifth consecutive year of top-line revenue growth in a really challenging economic environment. So the market values the entire company at just a fraction of the revenue it brings in over a single year. Wild, right?
All right, to understand what's happening under the hood, here's our roadmap. We're going to cover Ford's modern foundation, their real profit engines in hybrids and Pro, the EV strategy reset, dividends and deep value, and finally, we'll weigh the reality-based risks. Let's unpack the business.
Section 1. Ford's modern foundation. Let's take a look at their diversified core.
We really need to reset how we think about this legacy automaker, because today's Ford, it is no longer a monolith stamping out identical cars on a single assembly line. It actually operates through four targeted segments. It's like a giant puzzle. First, you have Ford Blue, which handles traditional internal combustion and hybrid vehicles. Then there's Ford Model E, focused entirely on electric vehicles. Ford Pro is their commercial vehicles and services arm. And finally, Ford Credit handles vehicle financing. So when we analyze Ford today, we aren't just looking at metal and wheels, we're analyzing a diversified operation handling literally everything from legacy work trucks to forward-looking fleet software.
Section 2. Profit engines. We're talking hybrids and Ford Pro.
Look, if you want to know where the massive cash flow is actually coming from right now, we have to look past the mainstream EV narrative. The F-150 hybrid was America's best-selling full-size hybrid pickup in 2025. In fact, Ford's overall hybrid sales surged by an incredibly impressive 21.7% last year, hitting a record 228,072 units. That was led heavily by the F-150 and the Maverick. While a lot of competitors placed all their chips on pure EVs, Ford recognized early on that consumers want efficiency, but without the charging infrastructure anxiety. This pragmatic powertrain diversification, it's proven to be a major financial strength for them.
Now, what's really interesting about this is the number 865,000. And no, this doesn't represent vehicle sales. Actually, it represents Ford Pro's paid software subscriptions as of early 2026. Ford Pro isn't just selling fleet vans to plumbers and electricians anymore. They are integrating connected, software-enabled fleet services. That right there is a highly lucrative recurring revenue stream. It completely smooths out the traditional boom and bust cyclical nature of the auto manufacturing business. A real game changer.
Just to put that into perspective, for 2026, the Ford Pro segment is expected to generate an average of $7 billion in EBIT. That's earnings before interest and taxes. Now compare that massive pillar of profit to the steady $2.5 billion expected from Ford Credit. Ford Pro is acting as a massive cash cow right now. It's giving the company the financial flexibility and, frankly, the breathing room to fund its future transformations without drowning in debt.
Section 3. The EV strategy reset. A much-needed pragmatic shift.
All right, it's time to address the elephant in the room. Ford is undergoing a seriously difficult restructuring of its electric vehicle strategy, and it starts with a staggering number, $19.5 billion. In late 2025, Ford took a charge of roughly this amount to write down its EV assets. It's a painful acknowledgement of the current market reality, along with a projected $4 to $4.5 billion operating loss in the Model E segment for 2026. The initial industry-wide EV push was just extremely expensive, and consumer demand simply softened. But taking this massive write-down is effectively management clearing the deck for a much more realistic, sustainable strategy moving forward.
So what does this actual path forward look like? Well, step one was that painful restructuring to streamline operations, which includes a new unified product creation unit.
Step 2 is shifting focus to a new universal EV platform, targeting a much more affordable $30,000 to $35,000 price range to actually reach mass consumers. And Step 3 is fascinating. They're expanding into battery energy storage systems for data centers and the electrical grid. They are actively aiming for Model E profitability by 2029 through these cost-effective platforms, strategic partnerships like the one they have with Renault in Europe, and these entirely new market applications.
Section 4, Dividends and Deep Value. Let's talk attractive yields.
So the crucial point is, what does all this massive cash generation from hybrids and the commercial pro segment actually mean for your portfolio, especially when weighed against the EV transition costs? Well, when you contrast typical market valuations with Ford, the company is trading at a deep discount. We are talking about a price-to-sales ratio of just 0.26 to 0.3 times, which is well below the broader market, and a Ford price-to-earnings ratio of under 8 based on 2026 estimates. The market is clearly pricing in those persistent EV losses heavily. But in doing so, it may be completely overlooking the absolute resilience of Ford Blue, the rapid growth of Ford Pro, and that undeniable hybrid momentum.
And here is the immediate reward for investors who are willing to wait for the market to potentially reprice that value: a reliable, roughly 5% dividend yield, which currently breaks down to 60 cents per share annually. Now, you're probably asking, is that payout safe? Well, management guidance safely supports this with an expected $5 to $6 billion in adjusted free cash flow for 2026. That strong cash flow generation comfortably covers the dividend, offering a really substantial income stream while the broader turnaround takes shape.
Section 5, Weighing the Risks. Time for some market realities.
Now, to have a complete, reality-based picture, we absolutely must look closely at the genuine headwinds Ford faces in the modern global economy. The global competition right now is fierce. CEO Jim Farley recently described the overcapacity and heavy subsidies of Chinese EV manufacturers as an existential threat. If global markets open fully, legacy automakers like Ford face an immense competitive risk from these incredibly low-cost international manufacturers. It is a genuine threat to their market share and pricing power for sure.
Expanding on that just a bit, let's rapidly outline these reality-based risks. First up, persistent EV losses could drag on, and there's always the danger of execution delays on their new, cheaper platforms. Second, the auto industry is inherently cyclical. They are highly vulnerable to high interest rates, economic slowdowns, and raw material costs like lithium. Third, there's constant regulatory and policy uncertainty regarding emissions standards and international trade. And fourth, high capital intensity. It requires billions upon billions in continuous investment just to keep the lights on and pivot to new technologies without completely straining the balance sheet.
But even with all those macro and competitive risks in play, it's worth noting that management's 2026 guidance already bakes in a lot of conservatism. Actually, they're officially guiding for $8 to $10 billion in adjusted EBIT for 2026. Plus, they are aggressively targeting over $1 billion in annual cost savings to buffer against those exact headwinds we just talked about. So, they are fully aware of the threats and are planning their financials accordingly.
Which leaves us with our final, provocative question. Is Ford a value trap or a brilliant long-term turnaround? You've got a century-old brand trading at incredibly low multiples, yielding around 5%, with analyst price targets clustering confidently between $13 and $17. But they're also navigating the most complex, capital-intensive transformation in automotive history. So what does this all mean? Is the market right to heavily penalize the EV transition, or is it severely undervaluing the massive cash generated by hybrids and commercial fleets? The data is all right here on the table. Now it's up to you to decide. Thanks so much for joining me for this explainer. Keep researching and stay curious.